Welcome to the Retail Focus Podcast, a weekly collection of news, interviews, and information from the world of retail. Here are your hosts, Trent Kling and Leighton Kling.
Welcome to this edition of the Retail Focus Podcast with Trent and Leighton Kling. Coming up on today's show, we'll talk taxes, real estate, and their connection with retail. We'll talk about Walmart's new convenience store foray and New York City getting a couple of flagship stores from two very different retailers. A quick reminder to like us and rate us wherever you do listen, whether that be iTunes, Spotify, or elsewhere. And as always, you can interact with us on Twitter and Instagram at Retail Podcast. Well, we lead our show today with PepsiCo, a company tangentially related to retail insofar as they sell a lot of their goods, obviously, in retail stores. And that's kind of the angle that we're going to be taking here is what's some of the new developments PepsiCo has coming down the pike that might affect retailers and, more importantly, might affect retail shelf space going forward. Now, they reported fiscal second quarter earnings that came in better than expected, and the company is renewing its focus on the Pepsi brand. You might have noticed the Pepsi rebrand of late, and they're introducing new and old limited time offerings in their beverage business. The conference call and press release came out on Tuesday of this week as we're in a temporary lull from earnings season for the bulk of retailers. Only a handful of companies, even in the U.S., have reported this week, with only a couple with ties to retail or food and beverage. So this will be light on earnings, this show will. But as far as PepsiCo is concerned, they reported second quarter adjusted earnings per share of $1.61 on revenue of just over $16 billion, $16.09 billion. Both major figures bested consensus analyst estimates of $1.52 per share and $16.04 billion.
It's a powerhouse company that we don't often talk about here on the podcast. We did talk about it during earnings season last year on the Food Focus podcast, but you see, this company has struggled as of late because cola sales in the United States are down, so they've really tried to hedge their business in a number of different categories, and we'll get into those. So it's not all bad for PepsiCo, despite you think of PepsiCo as having only Pepsi Cola. They have a lot of other business that's been doing fairly well as of late. Revenue was up 2.4% for the quarter, which exceeds their full-year top-line growth estimate of 2.3%. Overall, this year, Trent, they're up 3.1% for top-line revenue. Core adjusted earnings per share increased 8% versus last year's earnings per share. Overall earnings per share without being on an adjusted basis was actually down, I believe, around 13% for the company. Both gross margin and what they call core gross margin on that adjusted basis contracted during the quarter, but by a lesser degree than what they were expecting. So again, a bright spot for the company. Net margins actually grew as they were able to keep expenses down. Soft drinks continued to get hit hard when it comes to competition and consumer choices varying. That's why those sales are down in the United States. A lot of people are reading into the news that sugar, or at least a high quantity of sugar, is bad in your diet, but analysts have faith in their core beverage offerings still. They look at all of their zero-calorie beverages or their non-sugar added beverages. Those have been doing quite well. Bank of America analyst Brian Spillane says second quarter earnings per share exceeded his expectations by about 9 cents on a better than expected organic sales growth and operating margins. If you look inside their organic sales growth, they actually break that down on their formal press release. You can see that they break out beverages, foods, and all of the organic changes throughout every single one of their performing categories or performing segments. So not only in the North American division do they do that, but Latin America as well as overseas. And you can see that that's been a major growth driver. Innovation is what the company calls it, where they have either new brands or new brand extensions. And that very analyst said, while Gatorade and Mountain Dew improved throughout the quarter, colas are still a work in process. Spillane said that Pepsi has struck a healthy balance between efficiency gains, is investing to drive organic sales growth, and is delivering consistent sales and earnings growth. When we look at some of the notes here from the earnings call, we see that Frito-Lay, again, they supply more than just colas and other beverages throughout the United States. Frito-Lay was strong as always, but continued on an even more robust momentum track brought on by the company's first quarter results. The first quarter performed very well, did Pepsi, in their Frito-Lay category, but they performed well all of last year. So this is really just carrying up some better than expected momentum from last quarter. During this latest quarter, the second quarter, both volume and price points were up, which is an excellent sign for the company. What they called net price realization was up for this quarter, meaning that consumers have been okay with paying more at the register on average for the same exact thing they were last year. So they're okay to take in a few extra percent higher for the same product. They cited new innovative snack extensions and creative marketing initiatives that have helped to boost that price realization. Marketing was really a theme for them this quarter and during the earnings call transcript. If you read through that, you can really see that all of this talk of creative marketing was up, and really this is a sign for the future. They said a lot of the successes they had in this previous quarter or even in the first quarter were attributed to more marketing expense, that marketing prowess for the company. And you could see that. I was just watching TV the other day and I saw another Doritos commercial that was a little bit outside of the box from your conventional marketing, but it was on conventional means. It was on cable TV, and they continue to have success from that Doritos extension. The Doritos Blaze flavor, which was heavily advertised around the time of the Super Bowls when that first came out. Innovation was not all about new products either, but rather different setups within their own brands. For instance, they touted a new family pack, which included Lay's, Cheetos, and Ruffles. It was a 20-pack that they said is perfect for the summertime. Families go into the grocery store, need something quick and easy at a reasonable price point, and they choose to buy that because they acknowledge those brands, they're familiarized with those brands, yet this is another way that they can use that same innovation to drive sales.
Their North American beverages, though, remain in flux, although they do see strength in their trademark Pepsi and starting to see improvement in sales as a result of the Pepsi Generation ad campaign. Again, with some of those retro packages that they're pushing out, they want to increase marketing spend in the Pepsi realm. They're already very positive about Pepsi Zero Sugar and Diet Pepsi as well. As a sort of signal to investors that they should trust management's decision to boost marketing expense, they went back during the call and actually cited their sparkling water marketing efforts and how that has performed well, trying to draw a correlation between increased marketing spend and increased sparkling water sales. Now, granted, that was a new product. Everyone is well aware of traditional Pepsi products, so advertising and marketing there more to drive home top-of-mind awareness and brand recognition. Their new Gatorade Zero has also performed well, and pushing into some more of those foods like the chips that Leighton was talking about. Quaker Foods, which again is owned by PepsiCo, saw hot cereals gain some market share ground for the fourth quarter in a row. And this was impressive and a little bit surprising, particularly with hot cereals, as sometimes they don't always do so well in the summer, and it can be difficult to gain market share during the soft months for hot cereal. And it's even more impressive considering they do have newer market entrants, some of which we shop, for example, like Nature's Own, to compete against. Marketing's messaging here is focused on oatmeal's apparent health benefits, as it has for quite some time with their Quaker division. Another area of the company that is rather strong is Aunt Jemima's pancake line, with 7 quarters total of straight retail growth. Now, all of that marketing spend has got to come from somewhere, but management on this call was saying that it's actually going to come from those tax savings that we've been talking about through the first 6 months of this year. In addition to increased marketing spend from those tax savings, the company said that employee bonuses will take place for those employed in the U.S. as a result of the tax reorganization in the country. Now, one may still question current margin compression, but that's largely been brought on by commodities inflation with oil and aluminum, two products that, as you might note, aren't going into the actual food itself, but are used to transport or package the food. A side note here, metals theft is actually on the rise in some cities where aluminum and copper in particular have been targets, although that's not necessarily producing the complete rise in inflation. It is affecting the aluminum market overall. And then with oil, not only is it a factor with transportation, but they also cite a shortage of drivers, which is something that we've actually heard on several other earnings calls as well, where companies will say in the retail sector, hey, we're having a tough go of it in terms of margins because of transportation, and it's not all because of rising fuel costs. Fuel costs are going up, but right now drivers are at a shortage, and that means increased wages for the drivers they do bring aboard. Despite what Pepsi called a national shortage of labor, these wages for the company haven't nudged much, even though they have for certain other retailers and companies associated with retailers like Pepsi in the past. One other thing they spoke of on the earnings call was corporate social responsibility, and this has actually been a big note for them going on about 3 years now. And it's somewhat ironic, or at least we find it somewhat ironic, given some of their larger business segments, for example, bottled water being an extremely inefficient use of resources. High fructose corn syrup has been public enemy number one in recent years, but Pepsi claims to have brought clean water to a number of countries as a result of their bottled water, and they've made their trucking fleet more efficient as to reduce their dependency on diesel fuel. But this is more or less a cost-saving effort that's doubled to help grow their public image. And by the way, they're on an initiative as well to reduce added sugars in some of their, what they call their better for you options, or their better for you products. So Leighton, here between organic international growth and focusing on what they can manage well in North America, going forward, they feel pretty confident in their reiteration of earnings and their top line full year guidance, which a lot of people, when they came out with it, they saw as robust.
Yeah, between innovation and becoming a little bit more fit operationally, their CFO, Hugh Johnson, reassured shareholders that they believe PepsiCo can create value both in the short and long term. They are not taking their eyes off the prize long term, despite their recent beats in the second quarter. Shares of PepsiCo, ticker PEP, got an over 3% boost at various points on trading on Tuesday to over $111 a share from around $107 to $108 range. Prior to their earnings release, 1 year highs over $120 a share. They do have a 3.3% dividend given their current share price, which is still, by the way, as of Friday, still hovering around $111 a share. We move on to our second story with taxes, real estate, and retail. Three things that we love and we tend to talk about on this very podcast, particularly real estate as of late. So the Wall Street Journal recently reported about a slew of restaurants and retailers that are putting off plans to refurbish their stores due to an error in the recently passed corporate tax code. This is a tax code that we just talked about in our previous story, talking about the Tax Cuts and Jobs Act that was passed to help corporations reinvest in not only their employee base, but could potentially help other economies. If you think about, for instance, increased marketing expense could help the likes of Facebook and Twitter and things like that. So we look forward here at corporate taxation. This was not just an issue of reducing their effective yearly tax rate, but in that very tax code, there were some structural changes in how they expense certain items. Obviously, it was more than just a couple pages, and so you would read through there. It was put together pretty quickly. So as a result, there are dozens of errors, and they are now coming out as companies are looking a little bit more closely as to what it means for them for their fiscal year's end. But you see that depreciation expense, as a frame of reference, is typically 27 and a half years for residential properties and 39 years for commercial. What this means is if you're a company, let's say you're a restaurant, you decide to build a new freestanding building, it's going to take 39 years to expense the cost of that building. And for a lot of businesses prior to this, if they ended up having to do a major remodel or refurbish, they could actually expense that out to about 15 years, depending on the type of situation. Of course, we are not tax accountants by trade. One of the pieces of legislation that did not get pushed into the tax bill was reducing the 39-year mark for commercial properties. So that was actually a point of contention for some property owners. They were thinking that should be more towards 25 or 30, and that would obviously help them in the short term with tax relief, or they could deduct assessed property values a little bit more quickly by doing a number of different things there on the finance side. And well, one of the trade-offs was the immediate expense write-off for major remodels. Like we said, it took 15 years typically to end up writing that down through depreciation. But with many restaurants and retail businesses implementing a refreshed look, they wanted to actually increase that as well. So that was looked at as a potential 1 year benefit where you could expense all of the refurbishing or remodeling cost, a major remodeling cost, into a 1-year depreciation. And of course, that was going to help a lot of these businesses in the short term as they report their earnings results. Wendy's and Subway, to name two, have been looking to remodel some of their restaurants. They could benefit the most maybe from being able to depreciate construction costs up front. However, a loophole was actually made in the language, so it's a little bit different than what they had anticipated, so that corporate accounting experts have actually seen that 15-year mark not go to 1 year, but to go to 39 years. So for those retailers and restaurants that were looking to make a major remodel happen in this calendar year, they would have to expense that out over 39 years. So that is a major consequence of trying to rush this legislation through. And what is maybe the most interesting thing, according to the Wall Street Journal, this has significantly slowed plans for the privately held White Castle. They have already had a program in place to address aging locations, but this was actually going to be accelerated thanks to the tax plan of hoping to be able to depreciate in 1 year's time. A few months ago, tax representatives at the NRF said they were already seeing real implications from businesses as some budgets were tightening because they were acknowledging this loophole.
And this is a tough loophole to swallow, quite honestly, because here you have a bill that was supposed to accelerate growth in terms of not only reformatting, but also redesign of certain locations, which drives employment typically. But in this circumstance, we've seen actually the exact opposite as companies are beginning to realize what's actually going on with this bill that was unintended, we should mention. This is not an intended consequence. President Donald Trump has actually previously said that the immediate rehab write-off tag was maybe the most important element, and I quote that, of the tax code changes. So again, this was not intended to be the case. It was not kind of a bait and switch situation, if you will. And while some companies are tapering their immediate plans, some are going to go ahead and do full speed ahead on these refurbishing efforts. Their hope is that Congress will eventually address and revise before any real repercussions take place, and more importantly, before these corporations file taxes for their calendar year. And Congress people seem intent on addressing it next month, but there are a slew of other muddled issues that they have to debate and address. The more issues they have, the harder it's going to be to reach an eventual compromise that would close this loophole. Some other main issues are apparently with carried interest expenses for C corporations versus S corps. And again, according to the Wall Street Journal, Texas Roadhouse, Stage Stores, whom I will talk about in my Looking Ahead story, and the East Coast grocer Publix have all put forth letters to Congress letting them know the rippling effects if there is not some sort of quick resolution. Putting off projects means that the construction companies will suffer, workers may be without potential work, and then retailers may be forced to pay portions of contracts that they have just inked. And furthermore, if you go even to the tertiary impacts of this particular loophole, morale for retail workers could stay relatively low as the most aging brick and mortar locations are in dire needs of things like new checkout lanes, floors, backroom equipment, and also updated technology to more easily facilitate buy online, pickup in store options. And of course, these companies, Texas Roadhouse, Stage Stores, Publix, they're all in some sort of stage of either rebuilding or building entirely new locations. And they're not the only ones. We've seen a slew of retailers and, as Leighton mentioned, restaurants like Wendy's and Subway try to refresh those locations. But technology is changing so quickly that locations that were last refreshed in the 90s are in dire need of being refreshed now. And we can only hope that for retail's sake, this loophole is kind of closed off, because it is a big benefit to a business. If you can suddenly write something off in 1 year as opposed to splitting it out over 15 years, that makes a major bottom line impact and provides you a lot of incentive to go ahead and go through with any type of change. Well, coming up after the music, we'll be joined by Aaron Roy. He is the Chief Product Officer at Bond, and he'll be on to discuss a study about one particular method that retailers could be using to connect with customers, and it's a method that many have long forgotten about. Retailers and e-commerce companies have attempted all types of methods to stay in contact with customers, whether it's emails, texts, to those pretty annoying push notifications on your phone. Retailers' main goal has been to increase connectivity with their customers to create brand loyalty. In fact, this topic was front and center for most of last year's Shop.org conference in Los Angeles. However, there's a recent study commissioned by Bond that suggests retailers are overlooking a simple and time-honored way to connect with their customers. And joining us to talk about it is Aaron Roy, Chief Product Officer at Bond. Aaron, welcome to the Retail Focus podcast.
Trent, thank you so much for having me on.
Now, this way of connecting with customers that we're talking about is the handwritten note. And so what I want to do is kind of launch into the history of the handwritten note. This is something that retailers have used for a while. So when did retailers kind of start using it, and when did it kind of fade into the background?
So, retailers have been using handwritten notes for a long time. I want to say it's a tale older than time. But some historical standout moments, I always think of the story of Joe Girard. It's one that kind of influenced us a little bit. He's a prolific, super famous car salesman from the 50s and 60s, who every person who came into the dealership, he would write a note. It could be something as simple as "I like you" or "Thank you for stopping by." And he really preached the significance of the handwritten follow-up stood out. Different types of retailers along the way have utilized handwritten notes, whether you visited a counter at Macy's or Nordstrom's and you got a follow-up handwritten note, and it was very personal. From the day parchment and paper and pen met out, the act of selling something had handwritten notes have some piece. Over time, we saw that start to fade as phone and texting and all these different types of digital communications became more prolific.
So looking at your data now, there's really no getting around it. I think it's pretty clear. The survey you guys ran suggests that people value a handwritten note far beyond what they value an email, text, or any other form of contact. What is it about the handwritten note where people look at that and say, hey, this retailer gets me, or this is really special, this is something I want to hang on to?
When you get an email, emails can be wonderful. They can be beautiful. They definitely have a place, but it is very rare you print out an email and hang it on your fridge, right? But to get a handwritten note, the data we have today says, Americans receive a handwritten note, a personal letter, once every 7 to 8 weeks now. It really stands out. It's just not something you get. It's something that's out of the ordinary. It takes you out of whatever feedback loop you're currently walking in. And people still do, when they get personal letters, save them. This is something that goes into a memento box. This is something that, could be put on a fridge. It could be shared. It really is a throwback to a time where we've spent a little more time investing, creating something that would then have some level of lasting power. And with email, obviously, it's very difficult to get that same touch because we get so many of them. There's a lot of noise associated with that.
So you suggest that it's not only a matter of some psychological connection with the retailer, but also a matter of staying power. Have you guys found that there's also power in just the fact that, essentially a handwritten note, although, it's got some feeling behind it, is an advertisement that's almost ever present if it gets hung on something like the refrigerator?
Obviously, it has to be done right. A handwritten note can have that impact. It could be something that's kept. Reason being is, if a handwritten note is done well, it should be as personal as the customer who made the purchase. Or, in many cases, a handwritten note is simply a thank you. And if you're making a high value purchase and a brand goes out of their way to take the time to actually thank you, if you're buying a Ferrari, a thank you email, that feels wrong. It just doesn't feel like it's enough. But a handwritten note from a CEO saying, you invested the time in us, you took the time to buy this purchase from us. We just want to say thank you. And we really appreciated your business. Not only our data, but the tests we've done, the people we spoke with, this has impact. There is a definite emotional difference getting a handwritten thank you versus, a text or an email, something that can just be lost quickly.
There's a lot of numbers we could throw out in the study that you guys commissioned, but after Bond looked at the numbers, was there something that surprised you or maybe tweaked your approach even to handwritten notes for businesses and retailers?
Yes, I would definitely say, a couple actually, if you don't mind me mentioning them. One would be the 87% of millennials value handwritten notes more than alternative means, specifically for that generational piece. I'm a millennial myself. Texting, phone calls, all those things are great, and we do them all the time, but it does feel really nice to get a handwritten note. And if I'm going to go above and beyond investing in a brand, let's say I make a repeat purchase, getting a handwritten note back even if it's from a brand, the fact that someone took a pen, put it to paper, put it in an envelope, sealed it up, put a stamp, put it in the mailbox, that feels good. I mean, it feels like someone actually valued my business, and it does make me more likely to return. Another big data point that stood out, I mean, just basic high-level data point, is 3 in 4 Americans, 75%, so they haven't even written any sort of note to someone by hand, in at least a month. So it's not something that we normally do. So because we don't normally do it, there's probably a reason for that. And being that our business is providing handwritten notes, we realized, hey, maybe there's something there. People love getting them, but people really don't like writing them. Maybe there's something we can do to make that easier.
And to that point, one of the things I noticed in the data happened to be that sometimes people don't like writing handwritten notes for different reasons, but one of them is they don't like their own handwriting, or they don't trust the handwriting of someone in their organization. So what are some things that retailers can do, short of hiring a bunch of people with very good penmanship to handwrite notes all day, to connect with customers via the handwritten note?
I don't like my own handwriting, so it's a fair question. Well, at Bond, what we do particularly, our focus is providing handwritten note services at scale. So we actually have robots holding pens that are able to produce notes for people. But one thing we really focus on is being able to provide different types of handwriting styles. And by handwriting styles, I mean disparately unique. Every single letter, every single time will have variants and all these layers of complexity to people to choose from. Because I mean, me, myself, if I was to use my own product, I'm a fan of a handwriting style called Bushwick. Because unfortunately, just my handwriting is not very good. It looks like chicken scratch. But for those who have really nice handwriting, or, even just have handwriting they want to use, we offer digitization services. So people can use their handwriting, if they're going to send wedding notes or thank you notes or anything of that sort.
Now, although it's not retail, this is something I am pretty interested in. You mentioned robots with pens, and I know that conjures different images in the mind. You can actually see images of these on your website. But in terms of developing the robots, making sure that this looked better than something you just typed into a typeface on the computer and printed out, how did you go about duplicating all the complexities of handwriting and that pen-to-paper interaction?
Great question. I mean, honestly, tens of thousands of hours. It came down to a lot of research, a lot of hard work, and a lot of testing. We would conduct studies where we'd prepare handwritten notes via human, handwritten notes via our robots, trying to have people pick out the difference. We actually had the NYPD forensic lab come and analyze our handwriting samples produced by the robots, got feedback from them. It really comes down to using the best types of technology available, being able to make something available that can then be used, and then honestly just the feedback of our users. If people didn't use our product, we would think, hey, this isn't real enough, or we need to do a better job. But what we really started with is the handwriting has to be real. It has to be written by a pen. It must be ink on paper. It's critical that the ink smudges if someone gets water on it. It has to, for all intents and purposes, we really don't exist. It has to feel that we weren't even there. It's just someone who sent a note that was received by someone else and made a personal connection. We just happened to be the person who provided the service.
As we go back to retail now, or retail specific topics, I'm kind of curious about this because handwriting notes might be more important in theory for some type of retailers over others, particularly e-commerce retailers where you can't interact with them in a brick and mortar sense. Have you guys found that it's more crucial for certain types of retailers to execute on a strategy like this?
Absolutely. So the higher the value of the price, when we talk about things like LTV, customer acquisition cost, those pieces, the higher the perceived LTV, or the higher you want a lifetime value to be for a customer, really a handwritten note has to be part of that strategy, is my opinion. If someone's going to come to your website, really invest the time of spending, 2 minutes or 6 minutes a session and buy a product, and you want them to come back and buy another high value product, everyone is sending email. Like, you have to do that. There's no way around the email pieces. But if everyone is sending email, everyone's sending out promo codes, unless your brand already has a ton of staying power, you have to do something else. You have to do something that makes you stand out and stick. And that's where the handwritten notes really shine, is being able to connect with them in a way they just haven't seen yet. So I would say it shines best for e-commerce, luxury brands that, want a higher LTV and really want to cultivate an audience that they connect with that wants to return. It's not great for someone you never want to see again, a purchaser that's just going to, wander away.
Now, I'm curious, because you guys have kind of an inside look at the entire handwritten notes industry, so to speak, Have you seen an increase or a rise in more retailers kind of jumping on this and trying to execute on what might be kind of an inefficiency retail-wide, so to speak?
Absolutely. I mean, we're a 4-year-old brand. Every year we've been able to grow, which, I think signifies specifically that retailers have seen value in this kind of product and, there's a use for it. Even more specifically, we're working on something with Shopify that is coming out in the near future, just because we want to make available these types of tools on even an automated level. All of these different types of stores, whether you're a huge brand or a little brand, see value in these types of tools. So our job as a product is to integrate and make it even easier for people to use handwritten notes for as many customers as possible.
Aside from the partnership with Shopify coming up that you mentioned, are there any big technological developments in the world of handwritten notes that we should know about kind of coming down the pike?
That's a great question. I mean, so we just recently launched one on our side. We call it bond groups, but it's the ability to send multiple handwritten notes from a single session. And honestly, it was built not just for the retail space, but also very much for the wedding market. I myself am getting married very soon. I've seen this problem for lots of different people in this space, but sending 78 or 100 save the dates or 100 thank you notes, or in the case of a retailer, sending 100 invites to a conference is hard. So being able to do that very easily on a self-service tool is something we aim to build, and we recently released it, and we've had a wonderful success with it so far, which has been great because our users have given us tons of feedback, which has only made it better.
Aaron Roy, Chief Product Officer at Bond. Hey, congratulations on the upcoming wedding. Hope that goes well, and thank you so much for joining us on the Retail Focus podcast.
Thank you so much, Trent.
Well, we thank Aaron once again for joining us on the show, the Chief Product Officer at Bond, and we move forward with news from Walmart as they're looking to expand more in the ever-growing convenience store space. Now, let's take a trip back to 2016. At the beginning of 2016, we were just a handful of episodes into this podcast, and Walmart announced that they were going to shut down their express store concept in that first quarter. Those express stores, 102 in all, were directly competing with Dollar General, except they were about 20% larger than Dollar General on average, and they carried more groceries. However, the stores were designed to be in smaller markets, and overall, we thought it was a good concept, but in hindsight, the stores may have been too big. A lot of them also carried fuel stations, which was good for smaller markets, typically underserved in the fuel space. But the downside was they were getting a lot of groceries in that were spoiling too quickly, causing shrink. So they had issues with the merchandise mix. And their big downfall was that they were largely in rural markets that could not support the level of merchandise they had in terms of food and other items. One analyst actually speculated that they were too close to larger markets that already had a super center, basically taking customers that were already theirs at a different location, 10 plus miles away in some cases. But I think, at least on our behalf, we feel like the stores were well placed generally to attempt to take business away from Dollar General, who actually inherited a great deal of these locations after Walmart's exit of the concept. I was actually looking at real estate a few days ago from a city in Kansas, a small town in Kansas called Rose Hill, just outside of the Wichita area, where Dollar General moved into the former Walmart Express location and began carrying groceries themselves. Other retailers have also moved into the old locations, including Harp's Grocery, which has used the open locations to expand into different markets. But the bottom line is Walmart didn't see a margin there to try and continue their efforts in these small towns, but they apparently gained something from this whole experience. And as Leighton and I were joking about before the show, look, if you're in retail, as long as you don't go the Sears route and not learn anything from your mistakes, that's a positive sign. Walmart has apparently learned from their mistakes and learned that smaller may be the way to go for these small format stores. And maybe they also learned to keep fuel stations as a larger piece of the strategy. One other part of their new strategy, no longer are they looking at towns under 4,000 people, but rather they're looking at very large markets. And in fact, Leighton, this new concept is opening in Plano, Texas.
If we're being honest here, I think Walmart really was looking at those current margins in those express locations, those 102 locations that had to be shut down, and they decided to move out strictly because of that. They were looking at the bottom line and saying, this isn't necessarily unsustainable in terms of what they were bringing in, but it was something where they didn't want to go in terms of major growth for the future. So just after 5 years, they decided to shut them down. And I think they weren't scared of competition in the likes of Dollar General or anything like that. I think they just went too much too soon. I think they needed to have a slower approach, and I think that is exactly what they've learned here, and they're applying that knowledge from those express stores and all of their other concepts prior to that even, and applying them here with their new convenience store model. They just opened a new concept in Plano, Texas, and this is really how we are happening upon this story. They are wanting more throughout the Dallas area. In fact, so far the project is being set up as a trial phase per the company's spokespeople. They said they want to go slow and carefully in larger markets. And again, this is away from some of those rural locations that they had opened express stores, but they are, to Trent's point, still keeping gas stations. In that Plano, Texas location, there's actually going to be 8 fuel pumps in all. That convenience store is going to be around 2,900 square feet. And overall, Trent, that is about the size of a normal convenience store, or at least nowadays. They're a little bit bigger nowadays, around 3,000 to 4,000 square feet. Those larger concepts are seeing some success due to the amount of food assortment that they have and fresh food assortment. You see the Quick Trip kitchens really taking off in the Midwest, but overall, product-wise, it is very similar to what you would see at a Circle K, 7-Eleven, or the aforementioned Quick Trip. Interesting that they spy Dallas-Fort Worth as a target market, as there is fierce competition between convenience stores there, and Fast Track, Quick Check, Quick Trip, 7-Eleven, all having major influence. Kroger as well is in that particular area. They reportedly plan to open in Ohio and Florida, among other states. However, they are keeping pretty tight-lipped as to what metropolitan markets they have been eyeing. Their strategy here is something to keep an eye on. The stores, being around 3,000 square feet, are much, much smaller than the 12,000 average square footage of those express stores. That is only a minor difference compared to their growth strategy and location geography. It appears as though they are in no rush, like I said, like they were with express stores, where they were built out extremely fast and closed within just those 5 years of opening. They appear to be eyeing densely populated areas where Walmart is actually already at. So that sort of takes away the idea that they were cannibalizing their previous markets with the express locations that were on rural markets around 10 to 15 miles away from the nearest supercenter. Express was in areas with local populations that were less than 4,000 people oftentimes. And I think, Trent, this is a natural extension for Walmart. They already have fuel stations at a number of Sam's Clubs, a number of Walmarts. They obviously see profit from there. And I think if they were to be really in a bigger, more competitive market like Dallas-Fort Worth, I think that is a proving grounds for their concept, because honestly, I think a lot of their product assortment could come in at a lower price point, and people obviously are familiar with the Walmart brand, so they're at least going to be curious enough to come in and see the difference between their concept and the other concepts like Quick Trip and 7-Eleven that have been around for quite some time.
Well, we wrap up the news portion of our show by going to the East Coast and New York City. They're getting a dose of old retailers and young retailers, as 2 well-known outlets are opening flashy new stores. We're talking about Five Below and JCPenney here, and we'll begin with Five Below's first location in Manhattan. It's on 5th Avenue and set to open later this year. This story coming by way of CNBC's Lauren Thomas. We'll talk about her insight in a second. Now, that particular Five Below store will be about 10,800 square feet as opposed to their typical East Coast square footprint of around 8,000. They'll most likely carry more of different products rather than just holding more inventory of the same assortment they currently have. This location also allows them to take advantage of Toys R Us's absence from Times Square and allotting more of their square footage to those same toys. Now, as far as Lauren Thomas's insight, she was talking about how New York City landlords have had to be a little bit more flexible, being open to things like changing leases and splitting up buildings for development for multiple tenancy. Five Below's rent in this case will most likely still be extremely expensive, as is just about anything you rent in Manhattan, but they're only paying for about 10,000 square feet as opposed to the over 100,000 that we mentioned Toys R Us had. Under Armour, as we remember, took over some of that same space, and they basically admitted that it's more about boosting their brand image than the actual rate of return on sales at that location. From the Real Estate Board of New York, average asking rents declined in 9 of 17 New York corridors from a year ago during the spring. Still, rents on the upper half of Fifth Avenue, starting at 49th Street and close to Five Below's new store, were a whopping $3,900 average per square foot, which is absolutely insane. So it's really more of a marketing ploy for Five Below, an expensive one at that. But that's something that Joel Anderson, their CEO, did reference. He mentioned that it's a unique opportunity to enter one of the most popular shopping destinations in the world. But here's the key. He mentioned it was important to introduce new customers to the Five Below brand. And that's exactly it. It's really all about brand here, as opposed to the actual sales of the store. Now, this is just one of what's going to be many locations they're opening this year. In fact, 125 locations they have on tap for fiscal 2018, adding to the almost 610 they have in the U.S. currently. Now, we on the podcast, we're somewhat cautious on this New York City entry, as part of Five Below's success has come from the fact that they have decently sized stores in largely suburban areas with reasonable rent rates. They don't have a lot of urban area stores, and they do this in order to maintain margins. They stay out of those high rent areas. They're in very respectable strip mall centers, oftentimes with co-tenants like Marshall's, for example, or another off-price store, even Ulta Beauty alongside. But this kind of breaks that mold a little bit.
You look at the amount in rent that they might be paying for this particular location, 10,800 square feet times, let's say, half of the current average per square foot times about $2,000 per square foot in that particular area, that borough of New York. That is a lot of money. And one word that stood out to me during their formal press release on this, Joel Anderson said it's going to be an iconic destination. And I think that really speaks to the idea that they are looking at this, at least the majority so, a marketing ploy for the people in that particular area. But I think that they don't necessarily need to go that route. I think they're going to be looking at this location as a loss leader for the company. And just to put your name out there, I understand how important that may be, especially when you're around in some of the most popular shopping districts. But I think overall, they could have done with a shop about half that size and really looked at it as a place where, yes, we can get our brand out, but we don't want to spend $4 million a year for an unsustainable location, at least in terms of how it's going to return compared with their other stores. And like you said, Trent, they're already expanding throughout the United States at a very fast rate. Why try to hinder that potentially with a store that's going to underperform relative to their recent success? We move on to another store brand that is going to be extending their roots in New York City. JCPenney will be paying much less for their location per square foot, but that store is going to be much larger, and they're going to be eyeing a new Brooklyn store. Their new location will be in a big mall development at Kings Plaza in Brooklyn. The store will open on August 10th, so not opened yet, featuring the latest JCPenney brands, of course, and concepts in a tech-heavy and sustainable store design. And they're going to have all LED lighting. A lot of retail stores have been going to that as of late. Their LED lighting is said to be long-lasting, so they're not going to have to do much with that. It's also going to help on those monthly utility bills for JCPenney. They are on track to have the Energy Star certification from the EPA, which is a good thing. Not yet been accredited to them. It's going to happen once the store is open. And they also said they're going to have high efficiency HVAC units installed, which of course is going to help from the cost side of things. The Kings Plaza has roughly 1.1 million square feet of shopping and dining space. They hope to drive traffic with their redevelopment efforts. And it's not just going to be JCPenney that is putting forth capital in order to make things a little bit nicer, but all of the other stores there. It's going to be a multi-level mall. It's going to have some few high-rise areas where you can have a dining experience that overlooks some of their retail outlets. Like with the other New York City stores for JCPenney, this is going to be multi-level as well. The square footage is actually going to be fairly modest in terms of their average store footprint, coming in around 75,000 square feet. This is going to be their second Brooklyn store. If you look at a quote through the management there, they said this is actually going to be their second store, as their first Brooklyn store opened in 2014 at Gateway Center. And that store has actually received a lot of praise, a lot of sales, and this really has paved the way for this new store at Kings Plaza. And they say that it underscores their commitment to the high growth area and high potential markets. And so this really leads us to believe, at least, this may not be the only store, at least in the midterm, that they plan on opening in a major metropolitan market. The store is going to have a larger 2,000 square foot cutout for Sephora. Sephora obviously been a very valuable partnership for the brand over the past few years. They also said that they are going to have an expanded women's assortment, something they're looking at as more of a focal point for this particular store. JCPenney has operated stores in New York City since 1922, but that first Brooklyn store in 2014 was actually the first time they entered that particular borough. This is going to be the only store they are opening this year, and JCPenney has, of course, been closing stores, not opening stores, but closing stores over the last 3 years, mostly ones in smaller markets, or cannot sustain a Sephora, again, very valuable partnership, because of the size or the particular layout. They operate just over 860 stores now inside the United States and Puerto Rico. Not all are in older conventional shopping malls like one would think, but many exist in newer shopping centers and strip malls with the likes of the aforementioned Five Below. I was actually just in the Dallas and Houston areas where I saw JCPenney not in conventional malls as much as I saw them in shopping centers along the highway, and one actually right beside it had a brand new Five Below. So obviously they are trying to pinpoint newer, more popularized locations. They understand that retail is evolving. JCPenney may also benefit from added buy online, pickup in store features. Their customers are going to be pleased that they do have app integration within this particular store. So a lot of things are going to be happening that are tech heavy. Like I said, adding a store in such a dense area allows them to more expediently serve customers seeking both interactivity and convenience.
As always, we may have a position in or against companies we discuss on the podcast. Do not invest in stocks solely on the input of the podcast hosts.
We close out the Retail Focus podcast with a segment we call Looking Ahead, where each Leighton and I tell you about a story we're keeping an eye on over the next month, week, year, you name it, and we begin with Leighton.
My looking ahead is going to start with a quote from Marvin R. Ellison, who actually just left JCPenney, the last company we talked about, in favor of a spot at the top at Lowe's. He's now the CEO there. He made a statement recently, and he's been touring a lot of the stores, looking at their organizational structure, and he's making some very large changes within that company already. And this is a quote from him again. He says, "We have taken a fresh look at our organizational structure, and we are realigning our leadership team to improve our focus, better leverage Lowe's omni-channel capabilities, and deliver increased value for our customers, associates, and shareholders. As we make this transition, I would like to recognize the numerous contributions of the senior leaders departing from Lowe's and thank them for their years of service." So that is a very big statement in terms of, you can already see that some people, some senior leaders, are going to be leaving the leadership ranks of Lowe's. The chief operating officer, their COO, the chief customer officer, the corporate administration executive, and the chief development officer positions have all been eliminated, and those responsibilities are going to be spread out. However, there is positive news, at least if you are a leader wanting to make your way up in the company. They are opening some new roles, and some of these new roles are going to be fairly interesting, as they almost sound similar to the roles they are eliminating. They're going to have a new role effective immediately for the executive vice president of stores, and this is going to be a new position that's going to oversee the stores in the north, south, and west divisions. They're going to have a newly created role for the executive vice president of supply chain. This is going to help with distribution, but this really speaks to the idea that they are going to be focused on omni-channel in the future. And overall, some positions are going to stay the same. So the chief information officer is going to stay the same. Paul D. Ramsey is in that particular spot. And the CFO spot, as previously announced, he is actually going to be retiring. So he's not actually going to be laid off or pushed aside. Marshall A. Kroom is planning a retirement effective October 5th, 2018. However, an external search is underway, meaning that they aren't looking for internal employees to take the CFO reins. This is interesting, Trent, because all of these positions, it feels like the COO, the CFO, and all of the other positions, the administrative positions surrounding these senior management roles, these are very big positions. These are positions that have been around for quite some time, and a lot of the leaders that are leaving the company have been with the company for over a dozen years. So this really speaks to the idea that Marvin Ellison has come in and he thinks that large changes need to be made. But we were talking before recording, Lowe's isn't a company that you would look at, especially in the retail sector of all business segments, as one that is failing. It's not like they're Sears. It's not like they're any other store that has remained stagnant. They've actually been doing really, really well. However, in the face of their major competition in Home Depot, yes, they haven't done as well as Home Depot, but they're still doing very well. And operationally, I think they do have some things that they could improve upon, but it doesn't mean firing all of your leadership ranks, or at least a large portion of the people that have been around and tenured within the company.
Well, my looking ahead story has to do with the fashion sector, and it has to do with the company Stage. Now, Stage stores have been struggling quite a bit in terms of same-store sales. In fact, for their last reporting quarter, their comps decreased 2.8%. But they've got a very interesting way of dealing with this. Now, a lot of our frequent listeners will know that Stage acquired the bankrupt store chain Gordman's, which is an off-price store chain. Gordman's had to close a number of stores, and to this point, we've really only talked about Gordman's in terms of real estate, in that they left a bunch of real estate behind, and who's going to fill that real estate? Well, now Stage has found in Gordman's a willing partner in terms of opening new stores, not only opening new stores, but taking over leases from Stage stores that aren't performing well. So in this circumstance, Stage stores acquired a store that is only tangentially related to their overall business concept, and they're looking at certain markets and replacing Stage stores not doing so well with Gordman stores. Now, they did it once earlier this year in Rosenberg, Texas, but they're doing it now a couple of times this summer. And in fact, the most recent announced opening is taking place in Hays, Kansas, where a Stage store had been located in kind of an old downtrodden mall area. They're opening at Gordman's. In that particular market, Gordman's would be the first off-price retailer. And in fact, if you look at where Goodies are located largely throughout the Midwest and the South, there aren't a lot of off-price stores in the same town as Goodies. So this, I think, presents an opportunity for Goodies going forward to identify some of those stores that are dragging down same-store sales, that are dragging down the margins, and put a Gordman's in their place without having to pay those expensive lease-breaking fees. So could be a win-win for Stage going forward. Now, we should keep in mind that Gordman's was not a highly successful retailer to begin with, but they're in a successful retail space in off-price. And if they can beat TJ Maxx, Ross, or Marshall's to the punch by entering these particular markets, it may be a win going forward for Stage stores. Just something to keep an eye on as they begin to accelerate this process of replacing some Stage stores in certain markets with Gordman stores. That'll do it for us here on the Retail Focus podcast. For Leighton, I'm Trent, saying so long until next time. Remember, check us out on Instagram and Twitter at Retail Podcast. We'll be back 7 days from now.
This has been the Retail Focus Podcast. For more, visit our website at retailfocuspodcast.com and subscribe on iTunes or Stitcher. Follow us on Twitter at Retail Podcast.